Good morning from Naples, Florida. It's April 4th, 2019, and this is Mark Masterson, Managing Director and Partner at Hightower, Naples, and I'm bringing you our quarterly video market update once again. It was a fantastic start to the year, a great quarter. We're going to take a look at what happened, what changed for most asset classes, and we're going to look ahead into the second quarter, do our best to provide some unique insights into where we go from here. Let's get started. We've got a pretty big change in the four horsemen this quarter over last. If you watched my first quarter commentary in early January, you know that we were concerned on a number of fronts. But you also may remember that we did suggest that things could change pretty quickly if a few things were to take place. And they did. So here's where we stand today. On the fundamentals, we're still neutral. We know the fourth quarter came in at 2.2 GDP. Fully expect second quarter GDP will be lower. I'm going to show you where expectations are now, and earnings are going to be pretty lousy. First quarter earnings are going to be, revisions are falling hard, and we expect them to be a good bit lower. So from a fundamental standpoint, it's just not going to be a good quarter. The technical picture improved tremendously. And back in December, the charts were pretty much a mess. But since then, we've had, across most major averages, the moving averages, the 50 and the 200 have been recovered. It's a great signal that the rally's meaningful. The advanced decline lines have hit new highs on most major averages. The channel was tested. The bull market channel was tested and recovered. And I'm going to show you a lot of historical data, not a lot, but a good bit of historical data that suggests that the market's on pretty sound footing here. Sentiment's very neutral. It's mixed. Investors clearly aren't bearish anymore like they were. They were black bearish in December in what I consider a capitulation move. That's not the case anymore, but there's still some signs that there's a lot of distrust out there. So we'll look at that. And then here's the big one, policy. We're bullish. What happened? This was red, bearish, negative. Well, the biggest policy change came from Powell. He pivoted 180 degrees. He had a Damascus moment. The conversion of Saul was barely bigger than Powell's conversion here. He pivoted hard, and the Fed's on hold. So chances of a rate hike are pretty slim. In fact, we're seeing a higher probability that there's a rate cut because of the slowdown in growth. Big change that was a catalyst for the markets moving higher. The rest of the world is also in easing mode, concerned about growth. We call it kind of a global fire hose going on in terms of central banks stepping back. Fiscal policy is still a big boost this year. 2019 is kind of the last big year in terms of the economic impact of the tax cuts. And we are now seeing big-time progress in talks with China. So a deal looks highly likely, as we're all aware. What the details are, we don't know, but it's going to happen in the next month here, maybe two. And so that's a positive. And then lastly, Washington, the government's open. It wasn't earlier in the year. Impeachment with the Mueller report looks highly unlikely. While the dysfunction remains, gridlock is good. So our key points here on the four horsemen, a growth scare is going to happen in the first quarter. The second quarter will be important to see what happens beyond that. Policy error risk is now gone with the Fed stepping away from the brink. Monetary policy clearly trumps the poor fundamentals so far, and our sentiment remaining neutral provides some runway for the markets in 2019. Let me go ahead and show you some of the fundamentals in terms of pictures here. GDP. So here's where we stand. As I said, fourth quarter GDP was 2.2. The consensus has first quarter GDP, coming in, around 1.5. The Atlanta Fed has now been moving higher into the low 2 range. So we don't know where it's going to be, but the trend looks to be flat to down in terms of GDP. Growth is slowing. Economic surprises have been to the downside. As you can see here, the trend is pretty ugly. Really we saw a peak in early 2018, and we saw economic surprises fall off a cliff earlier this year. So this is all being reflected and was being reflected in the market back here at the end of the year in terms of the expectations. Earnings. Everything regarding earnings is getting weaker. These charts from Strategis show that first quarter expectations from analysts look to be pretty bad. I mean, pretty weak here in terms of the different sectors of the S&P. A lot of negative in terms of earnings growth. Revisions are coming down hard. We're seeing profit margins have kind of rolled over. And, one of the few bright spots is CapEx. CapEx continues to kind of rise here. And we're seeing a little bit of an uptick in M&A activity. But for the most part, this all looks pretty negative too. I slide this next chart in here because I think it might surprise you about earnings. So last year, earnings were fantastic. And what did the stock market do? It was a down year. So we had last year with earnings up, stocks were down. You can see there's a number of years that takes place where earnings are up and stocks are down. We also see earnings down with stocks down. Going back to the 1930s, there's been, 7 different episodes where earnings were down and stocks were down. These were usually pretty bad years. What surprised me was the number of years, which is most of them, where earnings are down and stocks are up, which is what I think is going to happen here in 2019. Certainly thus far, that's the case, where you have a bad earnings year and stocks rally. And that's surprising, and I thought you might find that to be interesting as a signpost, something to say, hey, let's not over-focus on the earnings picture. There's a lot of talk about recession. I will tell you, it does not look likely in 2019, that's for sure. There's certain things we look at. Nothing's perfect, but while growth is slowing and we're going to get a growth scare, leading economic indicators are still positive. I mean, clearly they're turning down, but we're still at around that 3% level. And the important point here is all these gray bars are recessions. In the past, these leading economic indicators actually crossed into negative territory before all of these recessions took place. So we got to watch for that before we get any type of real meaningful scare that we're heading towards a recession. And there's a lot of talk about the inverted yield curve as well. It certainly is predictive of a recession, but not the part that's inverted now. Right now, the 3-month 10-year is the portion of the yield curve that's inverted. And I will tell you, I almost put a slide in here, but I didn't think it was worth it. It's not very predictive, not very predictive at all. The one we really want to watch is the 2-year, 10-year, which is not inverted at the moment. And as you can see, when that one inverts, a recession always follows, but it usually takes a long time. These are months till the recession follows. And actually, the market tends to kind of chug along. There's the market returns between the times that it inverted and we actually hit a recession. So it's not something we need to overly focus on or get too worried about it at the moment, in my opinion. So in summary of the fundamentals, earnings are going to be pretty bad in the first quarter. Growth is going to be slow in the first quarter. We're going to get our growth scare. That was what was being priced into the markets in November and December. And so we need to watch and see how that plays out. We'll need to see if the reality is actually better than the poor expectations. That'll be very telling and very interesting. Let's just see how that plays out, and let's move on to asset classes, starting with the equity markets. Before I jump into stocks, I'll show you this slide. I think it's really interesting. If you look at last year, you might recall everything was red last year. It was a very bad year for almost all asset classes. 92% of tradable asset classes, according to Deutsche Bank, were negative to end the year last year. So virtually everything was down. This is a chart that shows through the first quarter the top 100 ETFs, which covers everything from stocks to bonds to commodities like gold, etc. A lot of green. You can see virtually everything that was down last year has started the year up in 2019. Well, let's take a look at this chart that I pulled right from my morning roundup a couple days ago. I'll give you a snapshot of the S&P 500. So if we go back here, we have this period here where we were going through the midterm elections in November. We get the normal chop. All of this is pretty normal. Midterm election years are volatile. Then we get what I call the Powell plunge. Jerome Powell's comments about the Fed being on autopilot. The markets just go into total capitulation mode. Right before Christmas, we get a bottom. And I will tell you, at this bottom, everything checked the box. The market internals were completely blown out. Investors were as bearish as 2008, 2009. Everything said we were going to get a meaningful bottom in terms of sentiment and market internals. And then we got the Powell pivot. So the Powell plunge turned into the Powell pivot, and the Fed that pivot really just sent the markets higher. We've seen it cross here over the 50-day. We get up to the 200-day. It offered very little resistance. We got over that. The market now is challenging and testing this major resistance where the market struggled around 2,800. It got above it, it pulled back. Now we're pushing above that too. So we're really getting a ton of positives. We got a golden cross where the 50-day crosses the 200-day. A lot of positives. I'm going to show you even more later on about how this market is performing thus far. But in reality, the market's really just following the script. In the past, when the Fed pauses, the market tends to go higher. This chart I showed in December suggested that if the Fed were to pause, which they did, this is the last 5 times the Fed paused and what happened. And you can see in almost every case, we went up quite a bit, right away. So the 2019 script is following suit after the Fed pauses. And in fact, even in 1995, it showed, leadership was technology, semiconductors. A lot of the same leadership groups are following as well in terms of a Fed pause. So again, the market's just doing what it normally does, following a Fed pause. The next few slides, I'm going to share with you some historical context of what we're seeing here in the beginning of 2019. And again, my goal is to try to give you some unique perspective, something you may not see everywhere, to provide an optimistic view here. Not Pollyanna, but optimistic that the 2019 could end up being a bit better than what many expect, as certainly a few months ago. Let me start with this one. So the first 3 months of the year, as you can see, were all positive for the market. This is a chart from Strategas, and I will tell you that bodes really well for the rest of the year. In fact, if you look at this chart, there were 19 different observations going back to 1950 where January, February, and March were positive. And if you look at the remainder of the year, and you just kind of run your finger down the line here, in every case but one, which was 1987, we had a positive result for the rest of the year, and the average return was 9.6%. So history's on the side of the rest of this year being good. Let me caution you, though, and let me point out one thing. It won't be a straight line, and it probably won't be easy. Because in the same chart, even though the results were positive, you can also see that the March through December period, in almost every case, we had a pretty good drawdown. So it won't be a straight line. There will be a pullback. It's probably coming quite soon, in my opinion. And so keep an eye out for that, but don't panic. Because as you can see, the average pullback was 9%. Some were only 4, some were 5, some were 13. And yet the market still finished positive. Here's one that was 14, and the market still, the rest of the year, you can't see that, but the rest of the year, the market was up 8%. So we will get a pullback. It is very, very likely, and but history suggests we're going to end the year on a pretty strong note. Another interesting data point, historical, that I found today in the roundup was the fact that this surge off the lows for the market has been so powerful. In fact, again, another Strategas chart here. They pointed out that the 65-day percentage change in the S&P 500 is in the 99th percentile of all observations going back to 1950. It's pretty rare, and what that typically offers us is that we'll get a mixed result in the short term, which would coincide with the pullback in the market. But the historical data suggests that when you get such a strong burst off the lows, that tends to feed bullish sentiment past the short term. So 65 days later, the average return was 5.5%. 125 and 250, we're looking at 8% and 15% returns for the market with a lot of positive results. So history, again, is pointing to some positive outcomes looking forward. And let's not forget a few things. One, we're in a post-midterm election year. Going back to the 1950s, they've all been positive. Every one of them, going back to the 1950s. And last year's pullback of 19 to 20% was right in the historical average of what is typical in a midterm election year. So midterm election years tend to be good for the market. We're in the third year of a presidential cycle. A lot of evidence suggests that it's a good year. So the third year is typically the strongest year for the market in a midterm election cycle. As you can see here, this quarter that we're in, these next 3 quarters tend to be the best 3 quarters of an entire presidential term. There's never been a recession in a midterm election, a third year of a presidential term. And the first 4 months of this year tend to be the strongest, and we're seeing that thus far play out. So the historical data is pretty positive and supportive for markets this year. I'm going to share with you now a little bit of insight and reasons as to why I think this bull market may have a little more room to run as well. First and foremost, you've seen this chart from me in the past, but this is a chart that shows when the market bottomed in 2009. Most people think this is one big long bull market, and it very well may be. I would suggest to you, though, that this market reset itself a few times. Back here in this window, back here in 2011, we saw the market pull back 20%. I think that was a bear market that really took place in it. So we have a bull market, bear market, then we had another long bull market. This window here, the S&P only pulled back over this 8 to 10 months, 15, 16%. But the rest of the world fell apart. If you want to pause this video and read what happened, you know, China down 50%, transports 32%, oil down 80%. I mean, that was another reset to this bull market. Then you have another run higher, and then we have the market fall 20% again last year. This could easily be viewed as one bull market. It could also be viewed as a bull, bear, bull, bear, bull, bear, and now potential another bull market. So that last slide kind of reinforces this theory that I've put out there on the roundup, where this bull market has been traveling this path of easier markets to harder, to easier to harder, easier to harder, easier to, we're in one of those harder windows. Then when we exit this, we'll be in an easier window. I also want to point out that even though sentiment is certainly not bearish like it was before, this market is not loved here. This is a recent study from Bank of America that shows that cash is still the largest holding for mutual funds right now. So they're not buying into this rally. Another view of the same shows this green line. This is the rally off the lows in the stock market. And all the while this has been rallying, stocks have been sold. You know, people are not buying into this rally. We're seeing outflows from equities as the market rallies. What does that mean? Hard to say, but I have to ask you the question. What do you think the market will do if this blue line reverses and starts to go higher as people add money in cash back to stocks? What do you think is going to happen there? So we have to ask that question as well. And of course, one of my favorite charts I show every time from JP Morgan is the inflows, outflows. And of course, as you know, I believe this bull market, if it is one long bull market, it's the most unloved bull market in history, because you can go back here to 2009 and look at the equity inflows in billions, and you've got, you know, these are pretty paltry numbers, and then you have 2 years of outflows, and then some great inflows, and then 2 more years of outflows, and then nothing. So there's just no love, and typically a bull market will end with a bang. It'll end with huge inflows, and we are not seeing that here. So where we're seeing it is in bonds. If you look at the bond market, look, we've got since 2009 nothing but love for the bond market. So, you know, at what point does that reverse and money leave the bond market and maybe come into the equity markets? That's something we have to consider. But as I've said a few times, sentiment is not where it used to be. I mean, as you can see, there's a number of different sentiment indicators that I use. None of them are perfect. This dumb money, smart money from Sentiment Trader is pretty good. The red line is the dumb money or the retail money. You can see they were just bearish as all get out. This was a historically bad reading in terms of excessive pessimism down here, while the smart money was pretty optimistic at the lows of the S&P. As the market has rallied, you're seeing the dumb money get pretty optimistic, and now it's kind of pinned up here in excessive optimism, where the smart money is kind of getting more pessimistic. So that's pretty normal behavior. But I do want to point out, normally this is a time where you want to get more cautious for the market and a pullback becomes much more likely. However, I will point out, as Sentiment Trader did a study, and they showed that when the dumb money excessive optimism is pinned up here, after being pinned at a historically bad level or negative level, usually the pullback tends to be pretty mild. So that's something we need to keep in mind. So let's move on to fixed income. Let's move on to bonds here. There's not a whole lot that we want to add or change. Our view remains the same. We think the bond market yields peaked back here in the 80s. We've been falling ever since. We think we're chopping up and down here for another few years before we start moving up in earnest. This bottom in rates will probably be just like the bottom in rates back here, back in the 1940s. And this is if you overlay the two, overlay this one on top of this one, is what you get here. So that would kind of indicate we get a chop, for the next couple years. So probably nothing too bad is going to happen in bonds and nothing too great. Finally, let's take a look at real assets, currencies and commodities, which I think there's some interesting talking points here, especially with the dollar. This is going to be one of the catalysts for the next year or two, is the U.S. dollar. This is the big picture view, the last 20 years. We think that the dollar is just grinding on this major resistance drawn from way back here. We had 3 peaks back here. We have 3 peaks here, and then the dollar went down. We think the dollar's probably going to go down here too and take a pretty big leg lower back down to this lower line. But we don't know. It's been incredibly strong. We had the sell-off here and then a rally, and it's been chopping and chopping and chopping. So time will tell. Can it break out and burst higher? It could. But perhaps with the Fed's pivot and the likelihood that the Fed's not coming back into the picture, we may see the dollar head lower, which would be good for commodities and likely U.S. As you know, we have a position in gold, a fairly small but relatively good position as a hedge on a lot of things. To us, the gold market has been choppy, and you can see it visually. It's just been choppy since it peaked back here in 2011. We had the 3-year bear market, and since then it's been forming what I think looks like a massive 4 to 5 year rounded bottom. These types of bottoms, once they're complete, we'll be heading to new highs, most likely in the case of gold in the coming years. And we do get the question, why hold some gold? I mean, there's a lot of reasons and theories on gold's value. It's a good hedge. It's an inflation hedge. It can be a deflation hedge as well. Geopolitical tensions. But for the most part, it's just a decent investment. I mean, if you go all the way back to 2004 and look at the returns in gold and dollars, yes, we had a 3-year bear market back here in 2013, 14, 15. That was rough. And everybody remembers that. But before that, we had nothing but upside. And since that, it's been pretty solid as well. So I think this was the bear market. We're now grinding in that 4 to 5 year rounded bottom. And the average returns have been solid at 8.5%. And I had to chuckle when I saw this chart. If I were to ask you or any investor really, over the last 20 years, which would you rather hold? Would you rather hold gold or the S&P 500? I would say most people would say the S&P 500. And they'd be okay with that. In fact, the S&P 500 last 20 years has been up 216%. Over that same time period, gold was up 362%. So, again, I think what we're seeing here is a nice big rounded bottom, and hopefully if the dollar were to break lower, gold will start to head higher as well. We also continue to wait on commodities. Commodities have been just in the doldrums for a couple of years now. You can see they peaked back here in 2011, had a horrible bear market. We think this is the bottom, rallied out of that, and now we've had this again as the dollar has been grinding higher, commodities have been grinding sideways. And I have this red arrow. That's kind of a wishful thinking there, that as if the dollar were to break down, if the commodity markets can break out of this multi-year consolidation, that's going to be a pretty powerful break. If it breaks down, it'll be powerful too. We think if the dollar breaks lower, commodities will break higher. We'll be watching for that, and maybe perhaps use that as an opportunity for clients down the road. But I wanted to keep you aware of that because I've covered that in the past. So I covered a lot of ground in this commentary. I hope I gave you a few insights that maybe you hadn't heard other places, to provide some color as to what we see happening here. It's not going to be a straight line. It's not going to be easy, but we remain pretty constructive here across most asset classes, particularly equities, in this environment. And this page here that you're staring at is my mandatory compliance and disclosure requirement. So thank you for looking at that. And this is where you can find us. You can reach out to me on the phone. You can email me. I'm happy to add you to the morning roundup, where I provide insights each and every day as to what we see happening out there in the market. And of course, you can feel free to call me with questions or comments or concerns. And I appreciate you being here, and we appreciate your confidence and trust.